If you're running a business, you know that inventory valuation can be one of the biggest headaches during a tax audit. So today, we're going to demystify it. We are going to zoom in on one very specific part, Clause 14 of your tax report, and give you a super practical guide to getting it right. Let's make this simple.
You ever look at the inventory section of your tax audit report, that Form 3CD, and just feel your head start to spin? Yeah, you're not alone. It is a huge point of confusion for so many business owners. But stick with me, because by the end of this, you'll know exactly what's going on.
All right, let's dive right in. The whole secret really boils down to understanding just one section, Clause 14 of Form 3CD. We're going to pull it apart piece by piece so you know exactly what your auditor is looking for and, more importantly, why they're looking for it.
Okay, so first things first, Clause 14 is split into two parts. Think of it as Part A and Part B. Part A talks about your closing stock. Simple enough, right? That's usually your finished goods and the raw materials you have on hand. But then you look at Part B and it uses a different word, inventory. Now this is the key. Under the tax rules, inventory is a much broader term. It also includes your work in progress, all that stuff you're currently in the middle of making. Getting this little difference is really the first big step.
So, seeing this probably sparks a big, scary question. It seems like the tax law wants one thing, but maybe your everyday company books do something else. So, does this mean you have to completely overhaul your entire bookkeeping system just to keep the taxman happy? And here is the answer, spelled out in black and white, directly from the official ICAI guidance note. This is the rulebook your auditor follows. It says flat out that you do not need to change the valuation method you use day to day in your books of account. For most businesses, hearing this is just a massive, massive relief.
Seriously, let that sink in for a second, because it is the most important takeaway here. Your books, your daily accounting, can stay exactly as they are. This shows there's a clear line between your internal records and your tax calculations. So how do you actually manage both?
Well, you bridge that gap with something called a Section 145A adjustment. The easiest way to think about it is like this. It's a separate, tax-only calculation. You take the numbers from your books, and then you make a few tweaks on a separate worksheet just to figure out your taxable income. Your company's actual financial records, they remain completely untouched.
Okay. Now that we've cleared up that whole changing your books myth, let's get down to the golden rule. What method do you actually need to use for this tax valuation?
Here it is. The one fundamental rule is this. You have to value your inventory at its cost or its net realizable value, or NRV, whichever one is lower. So let's make that practical. Let's say an item costs you 100 rupees to make. You can probably sell it for 150, but maybe it costs you 10 rupees for shipping and handling. So your NRV is 140. In this case, your cost is 100, which is lower than 140, so you must value that item at 100 rupees. This principle, taking the lower of the two, is absolutely non-negotiable. It's exactly what your auditor is going to look for.
But what exactly makes up the cost? It's not just what you paid for the raw materials. The official guidance is pretty clear. You also have to include any taxes you paid that you can't get back, and a shipping cost to get the materials to your workshop, and pretty much any other direct cost to get it ready. And this is crucial. Don't forget to deduct any trade discounts or rebates you received from your supplier. That lowers your actual cost.
So, when the auditor actually walks in the door, what are they going to check? It really boils down to three simple things. First, consistency. Are you using the exact same method you used last year? They hate seeing changes without a good reason. Second, correctness. Did you actually apply that cost or NRV, whichever is lower, rule properly? And third, documentation. Can you back it all up with clear, well-kept records? Okay, let's bring this all home. If you only remember one single thing from this entire explainer, please make it this next point. Having a smooth tax audit has nothing to do with changing your company books. It is all about having a consistent method for your internal records and then, separately, making the correct tax adjustments when you do your income calculation. You get those two things right, and you are in great shape.
So, I'll leave you with this one question to think about. After breaking this all down, is your inventory valuation method ready for its close-up? Take a fresh look at your process. You might just find that getting ready for your next tax audit is a whole lot simpler than you thought. Thanks for joining us. on the explainer.